Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The current level of the index falls between those two strike prices. It's a little closer to the 116, but it is between those two. So that would mean that I have a moderately bearish, not a slight bearish, but a moderate or a middle of the road, bullish perspective on the dollar right here. Since I'm buying at 48 cents and selling at 318, I can bring in a net credit of 270. That means 270 or $2,700 is my maximum gain here, because the maximum gain is equal to the credit received, right? Now, where does that maximum gain occur? Remember, to hit your max gain at expiration, you got to have both options expire worthless. In this case, that's going to require that this index move above both strike prices, or in this case, 121. So you'll notice here on my max gain line, I've got max gain 270, credit receipt occurs above the green line. So the green line that I drew in on this chart represents the 121 strike price, and you can kind of see that's where that's at. So if I'm looking at this chart and I've drawn this green line in, I have to ask myself this question before I do this trade. Does it seem realistic to me that the dollar could get back above that green line by expiration? Because ideally that's what I want it to have happen. Now realize this is May 2nd and these are May options, so they've only got about 2 weeks or so until expiration. Well, truth is, only about 5 days before this, it was well above that line, and in fact, it had been above that line for about 3 solid months. So certainly, that's very possible that it could get above that line. But more importantly, calculate my break-even price. What's my break-even? Well, my break-even is the main position strike, which is the more expensive leg, in this case, 121, minus my credit of 270. That sets my break-even price at 118.30, and in this case, I went ahead and drew that in as the yellow line here. There's my break even. So yes, ideally I want to get above the green line to make money, but the truth is I only have to be above the yellow line to make money at expiration, and look where I'm at right now. Heck, I was at that point at some point today, earlier. The intraday high was either at or just slightly above the break even for this spread. So it's incredibly possible that in 2 weeks I could be at least above that yellow line, and that's where I really need to be. Ideally the green line, but at least the yellow line, no problem, right? What's my max loss? Well, what's the difference between my two strike prices here? It's 5 points, right? And I brought a credit in of 270, which means my max loss is 230. So even if things go horribly wrong, even if the dollar just tanks and goes way down below the lowest strike price here, which in this case is 116, the worst case is I end up losing 230, and that's it, or 2,300. So that's this scenario. Now, turns out this was not a good trade, not a bad trade. It didn't work out. It wouldn't have worked out. Now that I have the ability to jump ahead and I've got perfect hindsight, I know that on May 22nd, which is the expiration date for this spread, the dollar lost ground relative to the Canadian dollar, and it closed at 115.03. Well, that's well below my low strike price of 116, which is my max loss level, right? 116. It was at 115.03. So it turns out that if I had done this trade on May 2nd, by May expiration, I would have lost. I would have hit my $2,300 max loss. This would have been a bad idea. So just goes to show you, technical analysis doesn't always work. All right, let's take a look at another example. Here's another bearish trade. I'm taking the dollar versus the euro. When I look at this chart, I see the dollar's been up and down, up and down. I'm expecting an upside move here, and the reason I expect it is because it looks to me like I'm breaking through an upside resistance, which is what I've drawn in here on a red line. Why do I believe there's resistance here? Well, here's why. Look, for the latter half of March, this index came up and touched this red line a number of times and could not get through it. Then it broke through right here at the end of March. It stayed above it for a while and then all of a sudden broke through again, and then throughout almost virtually the entire month of April, the dollar came up to this red line countless times, and every time it did, it was rejected. It could not get through that level. And then look what happened on the second day, or on the first day of May. It broke solidly up above that line again, and then now on the second day, it's still holding that line. Both times it came down to that level. And you know the old saying with technical analysis, this is resistance, then it becomes support, then it becomes resistance again, and now it becomes support again. So it looks to me like I've just broken through the downside resistance and created a support line from that. From that, I'd be willing to take a bullish position on this. So what do I do? Well, I'm going to take a look at this, a credit put spread. I'm going to buy the May $74 puts, and I'm going to sell the May $76 puts. This is just a 2-point spread. And once again, you can see that right now I'm at 75.04, so my index is falling right between the two, just about dead center. So this would be an at-the-money spread again. I can sell the 74s at 30. I can buy the 76s for $1. I'm sorry, buy the 74s at 30, sell the 76s for $1.20. I get a net credit of 90. In this case, that's a 10 by 10, so that's $900. Calculate your break even. What's your main position? In this case, it's the 76. Subtract your credit, and you get a break even price of 75.10. Now, here's a pretty cool thing. Look at this. Right now, the index is at 75.04, and I've just calculated my break even as of the May expiration to be 75.10. All I need is a 6-penny move here to make money. That's it. It's where the yellow line is. I drew in my yellow line at my break even. You can see the yellow line is just about right exactly where the stock's at now, just a couple pennies above. That's my break even. What's my max gain? Of course, my max gain is equal to my credit. To get your max gain, remember, you got to have both options expire completely worthless. Where does the index need to go in order for the 74 puts and the 76 puts to be completely worthless? Well, it has to be above 76, right? So I drew in the green line on my chart at my max gain point, which is right there, and that's 76. Well, you know, again, when you can visualize this, this is why I like to do it this way. I make a lot of my decisions, or I make decisions not to trade a lot of times based on the visual. When I look at this, did I say, hey, is it possible that that stock, that index could be above 76 in 2 weeks? Well, sure. It was, in fact, look right there, it was at 76 earlier today. It came back down, but it certainly could be there. It spent virtually the entirety of February, well, all of February, probably half of January, and at least half of March above 76. And then even going back here, October, November, December, a good portion of that was well above 76. So is it feasible to think that in 2 weeks it could be back up in this zone? I would say it absolutely is feasible. But guess what? Didn't happen. The dollar got pounded versus the euro. And I can look ahead now again, or look back with perfect 20/20 hindsight, and I know that the dollar closed at 71.44 versus the euro on May 22nd, which is way down about right there. 71.44. So not only did it not get above the yellow line or the green line, in fact, it went and took out these lows. I don't know what that level is right there, but that looks like it's probably somewhere around 71.90. I actually hit lows that it hadn't seen since way back in December by the time the May rolled around. So the dollar really got beat pretty hard. And you know what happens when the dollar gets beat? The price of commodities goes higher, right? We've seen that happen. So this trade would have been a loser as well. Now let's look at some good ones, because there actually were a couple of good ones. So what if I want to take a bearish position? I'm looking at the dollar versus the yen. Here's my chart. In my opinion, I see an expectation of a downturn. I think there's a possibility of a downturn, and the reason I say that is because it looks to me like the dollar is hitting upside resistance. And the upside resistance is the green line that I've drawn in here. The green line, it looks to me, is resistance. And why did I draw it there? Because May 1st and May 2nd, it hit that line and it got rejected. It got rejected here. It also got rejected here a couple of times in early March. And in fact, if you go back to November, you'll even see a couple of times where it came up to that level. On the downside, it broke through one day, but it didn't last long. Came back down. Go back to December, you can see that it hit this level here again. So I've got 1, 2, 3, 4, 5, 6, 7, 8. I got at least 10 or 12 instances in the last 6 or 8 months where this line was significant. It either was support a couple of times here and once there, or mostly it was resistance. And now that I've got 3 days in a row of red candles where it's come up to that level and it's now moving lower, it looks to me like that resistance line is going to continue.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.